In our last 3-minute explainer, we covered the repo market, so you could understand what it is and what it's used for. If you haven't seen that video yet, you might want to check it out before watching this one if you're not already familiar with repos. In that video, I mentioned that there were some big issues with this market that bubbled over in 2019, and those issues still exist. It's just that the Federal Reserve is currently taking action to control them. But what are these issues, and what caused them to come to light in 2019? Here's your 3-minute explainer. Repo rates are typically quite low in normal times, since the deals are collateralized and seen as being quite safe. The market is not usually a very volatile one. This changed dramatically in September 2019 when the overnight repo rate shot up from around 2% to around 10% in the space of a week. Since this market is so critical to the financial world, any disruptions can cause ripples throughout the whole system. In basic terms, if a market rate like this spikes, it usually means that the market participants are not wanting to lend. In this case, it seems to have been due to a liquidity crunch. The supply of cash available to lend out had reduced at the same time that demand for cash increased as more securities flooded into the market. With an increase in demand and a decrease in supply, the rate shot up. The Federal Reserve explained that these issues happened mainly due to two events occurring at the same time. Firstly, corporate tax payments drained the repo market of liquidity, and at the same time, the repo market was being used to finance an unusually large settlement of Treasury debt auctions. However, the Bank of International Settlements in their report have stated that these issues may have been among the problems, but they wouldn't explain the huge jump that happened. They focus on other, more alarming reasons. Most repo market activity moves between four large banks: JP Morgan, Bank of America, Citigroup, and Wells Fargo. This chart from the Bank of International Settlements shows how the repo market is depending more and more on these four institutions. This has led to some people, including the Federal Reserve itself, to blame these banks for the September crisis. Basically, if these banks even slightly reduce their lending, the market will suffer massively. Unfortunately though, since these banks have their own commercial needs and profit motivations, they can't be relied upon in the same way as a central bank, as they will need to prioritize looking out for their own interests. Jamie Dimon, CEO of JP Morgan, has shifted the blame. He says the bank had the cash available and would have been happy to lend it out and profit from the higher rates, but it was unable to. Since the financial crisis in 2008, banks have to satisfy regulations that require them to hold a certain amount of reserves, known as the Liquidity Coverage Ratio. So banks like JP Morgan may have reserves available, but are unable to lend them out as they need to hold on to them to satisfy the regulations, particularly at the end of the quarter, like in September or December, since that's when reporting takes place and they'll want their own balance sheets to look safer. In addition to this, banks may have been reluctant to lend as their reserves have reduced so significantly since the Federal Reserve started unwinding its quantitative easing since back in 2017. Banks had got used to having huge excess reserves that they could lend out thanks to the Federal Reserve providing liquidity. But once this stopped and the banks saw their reserves decline, it may have caused them to be a bit more cautious and to hold on to their reserves for themselves. There are more intricacies, pressure points, and problems at play, but this is the main overview of the situation, and it points to something quite troubling. All of these issues, and the fact that they only stopped when the Federal Reserve started pumping cash back into the system, suggest that there is a structural problem in this important part of the financial system, and this wasn't just a one-off event. In a future video, we'll explain more about the knock-on effects and risks that this may cause in the markets. But for now, if you liked this slightly longer than 3-minute explainer, hit the like button and don't forget to subscribe so you don't miss the rest. Thanks for watching, see you in the next one.